Then the last analytical tool that we need to look at is Porter's 5 forces. And Porter's 5 forces is used to analyze the industry's competitive structure. So if we are trying to analyze the competition within our industry, we can use this model in order to do that. And this is made up of 5 different areas. The first one, rivalry amongst existing competitors. The second one, threat of substitute products or services. Then the threat of new entrants. Fourth, the bargaining power of customers. And last, the bargaining power of suppliers. So these are the 5 different areas that we need to look at if we are trying to analyze the competitive structure of the industry that we are operating in. Let's discuss each of these in a little bit more detail. Rivalry amongst existing competitors. So guys, this is competition between companies that already exist within the industry. So the competition already exists. Now, barriers to exit. These are factors that prevent a company from exiting or leaving a market. So if you are operating in a certain industry, you are going to want your barriers to exit to be low. Because guys, if the barriers to exit are low, it means that your competition might decide to leave the market. However, if the barriers to exit are very high, then the competition is not going to leave the market, but instead they're going to stay within the market and are going to continue to compete with you. And you obviously don't want that. So we don't want high barriers to exit. We want low barriers to exit, so that our competition can leave the industry if they want to. So you can see if we discuss this in a bit more detail, if the cost of exiting is more than the cost of remaining in the market, then the entity is likely to continue competing, which we don't want. So for example, if they have a substantial investment in non-current assets, so they've spent a lot of money on non-current assets, or if they decide to close down, they have high retrenchment costs, if they have penalty clauses in their supplier contracts, or also penalty clauses in their rental agreements. These are all factors that would prevent an entity from exiting the market, because you can see the cost of exiting, because they've spent so much money on non-current assets, or there's high retrenchment costs, or there's penalty clauses. The cost of exiting is more than the cost of remaining in the market. So they are likely to continue competing with you. And we don't want that. We want low barriers to exit, so that if things start going wrong, the competition rather leaves the market and we then don't need to compete with them anymore. The next point we need to discuss in a bit more detail is the threat of substitute products or services. So obviously, guys, if there's a lot of substitutes that exist, the price that an entity can charge is going to be limited, because if you charge too much, then your customer is just going to go to the competition. But if there are not a lot of close substitutes, that means that the company can increase their selling prices and they can then earn higher profits. So what do we want over here? We do not want a lot of substitute products or services available on the market. Then the threat of new entrants. Now, please note the difference between this point and the first point. The first point, we were discussing rivalry amongst existing competitors. So competition between entities that are already in the industry. In the third point, we are discussing the threat of new entrants. So these are entities that are not yet competing with us at present, but they have the potential to do so in the future if they decide to enter the market. However, if they decide to enter the market, there are a few barriers to entry, and we want the barriers to entry to be as high as possible. Because if the barriers to entry are high, it means it's difficult to enter the market, and that means it's difficult for new people to come in and compete with our business. So you can see High barriers to entry strengthen the position of current players and makes it more difficult for new ones to enter the market. So, for example, if we are already in this industry, we will already have brand loyalty. So that makes it difficult for new competition to enter the market because customers are not yet familiar with their brand. We already have economies of scale. If you've been around for a long time, your business isn't just starting out, you're making more units. And the benefit of making more units is you can share your costs over more units. So your rental expense, etc., is spread over more products. In addition to that, when you go to your suppliers, because you are buying more products, you might qualify for bulk discounts, etc. But if there's a new company that's entering the market for the first time, you never just enter the market for the first time at that level. When you enter for the first time, you're going to have low production volumes. And if you have low production volumes, you're not going to benefit from economies of scale. Or lastly, a strong capital base. If we're a company and we've already been in the industry for 10 years, we should have a much stronger capital base than a new company that's entering the market for the first time. So it should make sense that companies already operating within an industry are going to want the barriers to entry to be as high as possible because that means new competition will not enter the market. Then if we look at the bargaining power of customers, if we have customers that buy in large quantities, those customers will have a lot more bargaining power than customers that buy in small quantities. So for example, they might try and bargain for lower prices, or they might also demand higher quality products. And higher quality products will obviously increase the cost of the company. And because we are dealing with a significant customer that buys large quantities, you will most likely allow these discounted prices or also accommodate them with better quality products because you don't want to lose this significant customer. Lastly, if we look at the bargaining power of suppliers, here we are talking about suppliers that have the potential to raise prices. So for example, if we have suppliers of products where there are only a few substitutes, then the supplier is more likely to increase their price and you are just going to have to accept that increased price because you can't get the product anywhere else. However, if there are a lot of substitutes available, you're then just going to change suppliers, unless there are high switching costs. If there are high switching costs, the supplier knows that they can increase their prices because you won't necessarily just change suppliers because the cost of changing suppliers is too high. That's what we're talking about with a high switching cost. So if we have suppliers where there's not a lot of substitute products available, or where they know that the switching costs are high, so if you want to change suppliers, the cost is going to be very high, then these suppliers have a lot more negotiating power or bargaining power, and they will then increase their prices because they know either there are not a lot of substitute products available, or they know you won't change suppliers because the cost of changing suppliers will be too high. All right, guys, so that deals with Porter's 5 forces. I just want to quickly have an overview of where we are sitting so that by the time we get to the end of our lecture on strategy, you guys have the bigger picture. At the start of this lecture, I said to you, if a company wants to be successful in the long term, they need to have a clear strategy. If they don't have a clear strategy, they are not going to be successful in the long term. If we want to develop a clear strategy, we first need to have an understanding of the internal and external environment in which we operate. So that's our starting point in developing a strategy. First, we need an understanding of our internal and external environment. And I went through 3 analytical tools with you that can be used in order to understand your internal and external environment. We can perform a SWOT analysis, a PESTEL analysis, or we can use Porter's 5 forces. After we have a thorough understanding of the internal and external environment, we then need to select appropriate strategies. And this is the next section that we are going to look at. So we are now looking at selecting appropriate strategies. So after considering the internal and the external environment, strategic options must be identified and the most appropriate options must be selected. So first, the company is going to look at their product and their market strategies. Then they are going to look at their competitive strategies. And lastly, they will look at their growth strategies. So when they are looking at their product and their market strategies, here they need to decide which products or services they are going to sell and which market are they going to aim their sales. So what product are we selling and what market are we going to sell that product in? Then we look at our competitive strategies. They need to decide, do they want to be a cost leader? Do they want to go for a differentiation strategy? Or are they going to have a focus or a niche strategy? Let's first look at the cost leadership strategy. If the company decides that they want to be a cost leader, then they are going to be focusing on keeping their costs as low as possible. So they are the lowest cost producer. So an example that I want to give you here is Checkers. If you look at all Checkers advertising, if you hear an advert on the radio, TV, anywhere, all Checkers advertising focuses on being the lowest cost. They don't try and focus on anything else. They don't say they're better than anybody else. They don't say that their quality is better than anybody else. They just say that if you are looking around for the cheapest cost, you should come to Checkers. So this is what their competitive strategy is. They want to be known as the cheapest shop when it comes to buying your groceries. On the other hand, you can go for a differentiation competitive strategy, and this is what Woolworths has done. This is where you have a unique product or service, or you try and perceive that you have a unique product or service. So if you look at a Woolworths advert, they never speak about being the cheapest. They always speak about having the best quality. And because of the quality, that obviously comes at a premium price. So that is the market that they've tried to put themselves in. That is their competitive strategy that they are going for. Or what you can do is you can get the best of both worlds. You can have a focus or a niche competitive strategy. And that means that you are a cost leader with some segments of the market, and then you go for the differentiation in other segments of the market. So depending on where you are selling your product, that determines what your price is. Then lastly, companies need to decide on what their growth strategy is going to be. So how do they plan to grow in the future? Are they going to grow by buying out or merging with other companies or through strategic alliances like joint ventures? Or are they just going to grow organically? And growing organically means that you are expanding your products into new markets and you are increasing your sales volume, and that is how you're going to grow. On the next page, we then need to look at analytical tools for assessing the feasibility of strategies. So we are going to look at two different analytical tools. And what this does is it helps a company, before they actually select a strategy, it helps them determine whether that strategy is feasible or not. So first we look at whether the strategy is feasible. When we know it's feasible, then we can actually select or implement that strategy. So the first analytical tool that we can use in order to assess the feasibility of a strategy is the General Electric Corporation model, or the GEC model. And what this model does is for decentralized entities. A decentralized entity means we don't have decisions being made at a head office level, but instead the company is broken down into different divisions and decisions are made at a divisional level. So that is a decentralized entity. So what this model does is for decentralized entities with multiple business units. So here's my multiple business units. It gives us a systematic approach to determine the best manner in which to invest their cash. So if you look at the diagram below, first over here at the top, we have the business unit strength, and then down the side, we have the industry attractiveness. Now below, I've also given you a little bit more information to help you interpret this diagram. When we talk about business unit strength, so above, this was on my horizontal axis, we are talking about the strength of the specific business unit. And factors that influence the strength of a specific business unit include their market share, their brand equity, and their profit margins relative to competitors. Then we saw on the left, or on the vertical axis, we spoke about industry attractiveness. And factors that influence industry attractiveness include the market size, the market growth rate, industry profitability, and lastly, macroeconomic factors. And we looked at these when we covered the pestle analysis. Now that we know what the business unit strength and the industry attractiveness means, we can now interpret the diagram above. So I want you to go back to this diagram. If the business unit strength is high, in other words, based on the factors that we looked at below, this means that the business unit has a good market share, they have a good brand equity, meaning that customers identify and know of their brand, and their profit margins are very good compared to the competition. Then that business unit has high strength. Then if we look at the industry attractiveness, if that is also high, that means that the market size, so the market where we are trying to sell the product, is large. It means that the market is growing rapidly. It means that the industry that we are trying to operate in is very profitable, etc. Then what we should do is the company should invest cash in that business unit. You should invest cash in business units where they have high business unit strength and also where the industry attractiveness is high. Definitely invest or focus on growing those business units. Then if you have any money left over after that, you can then give that money to other business units. However, if we have a business unit that has very low strength, so in other words, they have a very small market share, customers don't necessarily recognize the brand, they have very low profit margins when we compare them to the competition, that means they have a low business unit strength. In addition to that, if the industry attractiveness is also low, meaning that the market size is quite small, the market isn't really growing very much, and the industry is not very profitable, then we are dealing with low industry attractiveness. So if the business unit strength is low and the industry attractiveness is also low, then companies should obviously not be investing cash in those business units. So they should then divest of those business units. And divest just means you shut down or you sell off those business units because they are not going to be profitable. Or you can harvest them, but the only time you should harvest them is if you think there is a chance that the business unit will return to profitability. If you think the business will return to profits in the future, then you can try and harvest that business unit. So then you invest short-term cash in this business unit to try and help it turn around. So that's what harvest means. But normally, if your business unit strength is low and the industry attractiveness is also low, the company should not be allocating any cash to that business unit. First, you allocate cash to business units that have a high business unit strength and they have a high industry attractiveness. Then, if there's any money left, that can then go to other business units where we have medium business unit strength and medium industry attractiveness. Okay, so this GEC model is then one model that we can use in order to assess the feasibility of a strategy. We have another model that we can also use in order to assess the feasibility of a strategy, and that is the product market matrix. And this tool was created by Igor Ansov, and the aim of this model is to provide entities with growth strategies. Okay, so guys, an entity might decide that they want their growth strategy to be market penetration. And if they want their growth strategy to be market penetration, that means that they are going to achieve growth without deviation from their original product or market. In other words, growth is achieved by increasing their sales volumes of existing products to existing markets. So that's one growth strategy. Alternatively, the company can have a market development strategy, and that is where growth is achieved by selling an existing product to a new market. Or the company could have a product development strategy, and that is where growth is achieved by selling new products to existing markets. Or lastly, you can go for a diversification growth strategy, and that is where growth is achieved by simultaneously changing your product and also your market. All right. So once again, let's go back to where we are sitting in terms of the bigger picture. So we've already looked at the analytical tools that can be used in order to obtain an understanding of the internal and external environment. We have also looked at selecting appropriate strategies. We are now going to look at implementing the strategies. So if you go back to your lecture notes, so after we have selected our strategy, so we looked at that in step 2, we've selected our appropriate strategies. We now need to translate those into clear objectives which are measurable. So in other words, they must be translated into KPIs or key performance indicators which are measurable. Those KPIs must then be communicated throughout the entity, and they must also be incorporated into performance management systems so that the entity can achieve their objectives. So it's obviously very important once the company has selected their strategies. They can't keep this a secret and only senior management works at trying to achieve those strategies. All employees within the company need to be working towards the same common goal. If any of you have ever worked, you would have also been involved in a performance evaluation where you had certain KPIs or certain targets that were set for you and you have to achieve those targets. So it's very important. We don't just have employees achieving certain random targets. Everything is aligned. So strategies are set by senior management and they determine the KPIs. And that is then communicated throughout the organization. And the KPIs that each individual employee has to achieve is aligned with the long-term strategy of the company. So it ensures that all employees within the company are working towards the same common goal. Everybody is trying to achieve those selected strategies. And then in addition to that, the most important KPIs are going to be communicated to stakeholders in the integrated report. And then finally, to wrap this up, we are going to measure performance against strategic objectives. So finally, we can wrap up this process. First, we understand the environment. We then select appropriate strategies. We implement those strategies, and we measure our performance. And that is the entire process. So KPIs should be measured and reported on at regular intervals in order to assess the progress of the entity towards the stated objectives. So they have their objectives. are they now actually achieving those objectives? And what's very important is the KPIs should have a balance between financial and non-financial measures. It's important to incorporate non-financial measures into performance management systems so that entities achieve long-term sustainability. The problem with only focusing on financial measures is we then only focus on the short term. And we don't want companies just to focus on short-term profits. We want companies to focus on being sustainable in the long term. And in order to do that, we need to make sure that the KPIs do not only focus on financial measures, but also include non-financial measures. So for example, what could your KPIs be? Your KPIs could be financial ratios, because obviously we don't ignore the financial side of things. We still have to take that into account. But in addition to the financial ratios, we can also look at things like the amount of water and electricity that the company used during the period, their CO2 emissions, the amount of money that they spend on training employees, the number of accidents that happened during the period or employee injuries that happened during the period, etc. So we don't only look at financial ratios. So volume of water and electricity used. So you can see we focus on the financial side of things. We also look at things from the people or the social perspective. So how much money do we spend on training our employees? How many employee accidents were there during the period? And we also look at things from an environmental perspective. So the volume of water and electricity used, our CO2 emissions, etc. The balanced scorecard is one method that we can use to ensure that we combine both financial and non-financial performance measures. But you guys can just read through that. So as an overview, this is how the process works. First, we understand the internal and external environment that we are operating in. There are various different analytical tools that we can use for this. We can perform a SWOT analysis, a PESTEL analysis, or we can also use Porter's 5 forces. Then once we understand the environment that we are operating in, we can select strategies that we would like. Once we've selected those strategies, we then need to implement those strategies. So we implement them by creating KPIs and communicating those throughout the entire business. And then lastly, we need to measure our performance. So what we do is we compare the actual results to the KPIs that we previously set, and we see if we are on track to achieving the objectives of the company. So that is your overall process when it comes to strategy. Then just to wrap this up, guys, it's important that you understand what the business model of a company is and what goes into the business model of a company. So firstly, the business model explains how the company achieves sustainable value. So what is the reason why the company exists and how do they make money? And the ability of the company to generate value depends on the external environment that they operate in, their relationship with their stakeholders, and also their access to resources or capitals. So please, guys, just below, I discuss all of these resources or capitals in a little bit more detail. This is very straightforward, so please just read through all of this, just so that you are comfortable with the different types of capitals or resources that a company has at their disposal. Then in addition to that, I also have the key building blocks of a business model. So it's important to note that your business model is going to have to be continuously adjusted because of the fact that we are dealing with a fast changing business environment. So you can't just have your business model established today and then never adapt that. You need to take into account changes in the business environment that you are operating in, and you then need to update your business model accordingly. But there are certain key building blocks that we take into account when we develop the business model of a company. And once again, guys, please will you just read through these key building blocks so that you know exactly what should go into the business model of a company. All right, and then that deals with everything that you need to know for strategy.